Good morning. Welcome to CEDA's live stream on rates, rents and a rising cost of living. My name is Andrew Barker and I am a senior economist at CEDA, the Committee for Economic Development of Australia. CEDA acknowledges that today and every day we are on Aboriginal land. Committed to recognition and reconciliation, we respect elders and we support their stated aspirations. Today I'm joining you from Brisbane on the land of the Yagara and Turrbal people. I'd like to extend a warm welcome to those joining us online and welcome our panellists, Julie Toth, the Chief Economist at PEXA, and Angus Moore, Economist at REA Group. The format for today will see each of our panel participants give brief presentations from their perspective, followed by a Q&A session. Today, as at all CEDA events, you can interact through our Q&A portal, which is available via the link on your screen, or you can go to ceda.pigeonhole.at and use the passcode cost of living, all one word. Post your own questions and vote on the questions by others. You can put forward your questions at any time and we will endeavour to answer as many as possible during the allotted time, particularly Julie and Angus. You can also join the conversation on Twitter by using today's hashtag, which is #costofliving and tagging @CEDA_news. Australia is in the midst of the most rapid monetary policy tightening cycle in almost 3 decades. The target cash rate sat at a record low 0.1% during the pandemic before 5 successive rate rises that have seen it spike to 2.35%. A further rate rise is expected to be announced this afternoon, with the only real uncertainty around the magnitude of that increase. Monetary policy tightening is underway as the Reserve Bank seeks to return inflation to its 2 to 3% target range. Spurred by the recovery from the pandemic, supply chain constraints, and high energy prices due to the war in Ukraine, inflation is running at its highest rate since the early 1990s. The ABS's new monthly inflation series last week revealed that prices were up 7% in the year to July. Price rises like this, well in excess of wage growth, are creating a cost of living crunch. An increasingly important contribution to high cost of living are increases in housing costs. So house prices rose rapidly in 2021, in part due to low interest rates, but also due to increased demand for housing space with a shift towards more working from home. Central bank researchers in the United States have estimated that remote working was responsible for a 15% increase in house prices in that country between late 2019 and 2021. While house prices are now falling with the effect of rising interest rates across Australia, increasing interest rates are making housing less affordable for those with mortgages or looking at taking out a loan to buy a home. Unlike house prices, rental prices are still increasing strongly, compounding cost of living pressures for renters. The trend towards working from home has had a similar effect on rents as it has on house prices, with capital city average asking rents up 20% over the past 12 months. Almost half of low-income rental households spent more than 30% of their gross income on housing costs prior to the COVID pandemic, so increasing rents represent a significant burden for those least able to afford it. Nor have we seen the full impact yet, as it will take time for rent increases to flow through as rental contracts expire and new agreements are negotiated. I want to end with something a bit more positive, which is that the Australian economy has been pretty well insulated from some of the worst effects of the energy crisis globally, as it has benefited from high commodity prices. An important question in this context is how this good fortune can be leveraged to protect those at most risk from the cost of living crisis. In this context of rising rates, rents, and cost of living, I'm pleased to invite Julie to first make her opening comments, followed by Angus. Thank you.
Thanks, Andrew, and welcome everyone today. It's great to be talking about this topic again. We have, of course, got the RBA meeting as we speak, the board and the executive there, and they'll be announcing their next cash rate decision at 2:30 this afternoon. Odds are on that it'll be another increase. Most of the market economists are tipping another 50 basis points, but it is possible that they'll slow the pace and raise their rates by, say, 25 basis points today. Firstly, I wanted to just make a few nerdy comments about Australia's inflation data, Andrew, just as an economist. For decades, it's been quite frustrating for those of us working in Australia that we've been unique among advanced economies for only having an official measure of inflation, at a headline level and in detail once per quarter. For a long time, Australia and New Zealand have been the only countries that have done that. Everyone else has had monthly numbers. Much to our delight, the ABS is now moving to a monthly indicator. They've only just started publishing that. So as Andrew already mentioned, that's been available since June. And so far for June, July, August, it's showing a peak at around 7%, dropping a little bit in August, but it's probably too early to say that that's the peak and that we're over the worst of the inflation cycle. But generally, the signs are looking good that we may actually be past that peak in inflation pressures. What's interesting in the detail, though, is both the quarterly and monthly inflation measures confirm that what we're seeing is an unusually widespread range of pricing pressures across goods and services in Australia in 2022. And what I mean by that is, the nature of the price rises are touching almost every category of goods and services that households buy, and for quite a range of reasons. This means that it's much harder to avoid the price rises by simply switching to another product, by substituting. So in the past, for example, where we've seen, single items or single categories impacted, for example, by, banana prices going up due to cyclones, you can substitute. That's almost impossible to do at the moment because the whole food category is rising. We're also seeing price rises for essential goods and services that are difficult or impossible to substitute. So that includes big categories of spending like petrol, housing rents, and electricity prices. Now, some of these pricing pressures will reduce of their own accord, and from a policy perspective, that means they may not require a response. For example, the global supply chain disruptions that we've seen due to COVID-19 are being overcome. The effects of floods and natural disasters on food production in Australia and elsewhere will fade over time. So these types of events may not require a response. So why is the RBA responding? Well, the widespread nature of inflation also reflects very strong demand for goods and services across the economy, and probably beyond the potential for the economy to supply those goods and services at the moment. So we do need to see a moderation in demand or a big increase in supply. Now, moderating demand is easier than a quick fix on the supply side, and that's where the RBA's cash rate comes in. So the cash rate is a notoriously blunt policy tool. It does have that reputation, but it's very effective in circumstances where inflation is due to excess demand. The transmission mechanism, as Andrew already noted, can take quite a while, moving from those higher rates through to the low inflation scenario. It's lengthy and somewhat convoluted. So, the example we already heard was for rent agreements, waiting for those to tick over and see what the rent increase is at the end of that tenure. For mortgage holders, that's also quite long. So from the process of the cash rate being announced, it'll take a bank, maybe only a couple of days to announce their response. However, implementing it can take a sequence of several months before it actually hits a mortgage holder's bank account. And this is why, the sequencing and the timing of these rises is really important. Rate rises do, of course, have some fairly nasty side effects. Because they work by dampening demand, we will also see a deceleration in GDP and possibly employment growth. But in the current scenario where the economy is arguably running beyond its potential growth capacity, and we are seeing shortages across the board in skills, in building materials, in other key segments, maybe that's not such a bad thing. We simply don't have the spare capacity at the moment to ramp up demand, to ramp up supply, I beg your pardon, in response to demand. Moving on though to the housing market implications and putting on my PEXA hat and looking at the data that we have available to us, the responses from households to the rate rises are relatively rapid, and a good way of thinking about this is in the same way that, you know, people don't wait until they've become unemployed to, you know, look for new work or to look for an alternative source of income. Households don't necessarily wait for that rate rise to actually hit their account before they respond to it. And what we're seeing in the PEXA refinance index, which we update and publish every week, is record proportions of mortgage holders in that variable category looking to refinance their loans. They're actively looking to reduce their housing costs, reduce their mortgage costs ahead of those rate rises. For those that are on fixed loans, they do need to wait until the end of their fixed loan term in order to seek refinancing. But certainly in that variable category, we're seeing record proportions. Now, about 35% of Australian households are in that owner-occupier with a mortgage category. It's the single largest category of housing tenure in Australia at the moment. So that it's quite significant. And the rate rises that we're seeing do add considerably to the typical mortgage bill. So working on a typical variable rate mortgage of, say, $500,000, which is a scary big number, but it is fairly close to the average. Just the last rate increase in September would have added about $2,500 to their annual interest bill, or about $200 a month. And if we look at the cumulative increase of 225 basis points so far this year, that will have added over $11,000 in their annual interest bill. So it's a very big hit. For those on the fixed rate loans, that is delayed until the end of their loan tenure, but then they'll see it in a big increase rather than those smaller increments. Now, the consumer finance research that we conducted in May, that was on the backgrounds of about 8 million mortgage holders across Australia. And about 2.3 million of them have either refinanced their loan in the past year or intend to do so in the next 2 years. So very significant numbers of households are reacting to these rate rises. And of course, if they're doing this with their loan, they're probably doing it across the entire household budget, looking for savings that they can make. Just finally, Andrew, on the other big large category of households for Australia, renters, that's about 32% at the moment in the last census. They're being squeezed, as you pointed out, on the rental side. But for those that are looking to take out a loan, you know, many renters do aspire to become home buyers. It's a big thing in Australia, has been for many, many years. House prices might be falling a touch, but with the rate increases, it means the maximum loan size that they're able to borrow will be significantly smaller. The RBA, in a speech just a few weeks ago, calculated that the 225 basis point increase already so far this year will have reduced a typical new home buyer's borrowing capacity by around 20%. So it really brings down the price points that they can look at, and it does mean that inevitably we will see fewer people moving from renting into owning in the housing market as a result of the rate increases.
Thanks a lot, Julie. I'll now pass on to you, Angus, to give your opening comments. Thank you.
Thank you. And thank you everyone for joining us this morning. I think very interesting time and very interesting topic to be talking about. To kick off this morning, I thought I'd talk about 3 trends that I think are really important for understanding where housing's come from across the pandemic and where we're sitting in sort of late 2022. The first I'm going to talk about is housing prices, because it's easy, it's fun, everyone loves housing prices. So we'll start there. Across the pandemic, so from February 2020 to March 2022, when prices peak, prices nationally grew 35%. 2021 alone was the 3rd fastest year of home price growth in 140 years. So by any measure, prices have grown incredibly briskly. Now, it's not been evenly spread. We have seen divergences in where this price growth has happened. So regional areas have grown faster than capital cities. We've seen smaller capital cities like Adelaide, like Brisbane, like Hobart grow faster than Sydney and Melbourne. We've seen houses significantly outperform units. There's a lot of trends driving those differences, and I'm sure we'll talk about a lot of them. But one of the really key ones was that people just wanted more space during the pandemic, and that drove a lot of those divergences that we see in price growth there. So that's my first trend. For my second and third, I'm going to kind of change tack pretty abruptly and talk about rental markets, because I think in 2022, they kind of are the key part of the housing market for me, and one of the areas where we're seeing the most stress. So the first trend I'm going to talk about is on the rental supply side and investor activity. So the headline here is pretty simple. Rental supply is well down compared to pre-pandemic. The number of rentals available and listed on realestate.com.au is down something like 30% compared to where it was pre-pandemic. Vacancy rates are low around the country, and we're seeing advertised rents grow very briskly as a result. Part of why we're seeing this is that we saw a lot of investors sell out of the rental market during 2020 and 2021. So we can match up properties that we see listed as rentals on realestate.com.au with their subsequent sales history. And through the pandemic, something as high as 3 in 10 of every sale that happened during those periods was an investor selling. At the same time, we saw relatively few new investors coming into the market. So ABS data on mortgages showed that the investor share of new housing lending fell to as low as a quarter. It's normally something more like a third, and it's back to about a third now. What that means, those 2 trends, is that relative to what we might otherwise have expected, there just are fewer rentals than might have otherwise been the case. So that's part of why rental markets are tight, but it kind of can't be the whole story, because if an investor sells, they have to sell to someone. If they sell to another investor, obviously has no impact on the rental market. If they sell to a first home buyer, and we did see a lot of first home buyers buying through 2020 and 2021, it should also kind of have no real impact on the rental market, because while you're losing the supply of one rental property, you're also losing one probably renter household. Maybe not, they might have been living with their parents or some other tenure arrangement, but probably they were a renter household. So you lose one demand, one supply, should have no net effect. So that rental supply can't be the entire story for why rental markets are as tight as they are. So that brings me to my third and final trend, which is rental demand and household formation. During the pandemic, what it looks like is renter households just got smaller. And I don't mean the physical size of the dwelling, I mean the number of people in the household. So this would be consistent with share houses, your sort of 3 or 4 person house becoming less attractive during the pandemic, if you're working from home, if you're having to isolate, and instead people moving into 1 or 2 bedroom apartments. Now, household formation is really difficult to measure. We don't have great data on it. This is part of why we run the census, but it's only every 5 years. But the data that we do have kind of points in this direction. So if we look at what renters are searching for on realestate.com.au, we are proportionally seeing more searches for units than for houses than was the case pre-pandemic. Similarly, if we look at what's actually being rented on realestate.com.au, we saw a big surge in the share of units during 2020. And there is survey data of households that suggests share houses became less common and household sizes became smaller during the pandemic. So where that all leaves us, obviously prices are well up compared to pre-pandemic, but we are starting to see them come back now. The PropTrack Home Price Index, which was out over the weekend, showed nationally prices are off about 3.5% compared to March. At the same time, we're seeing incredibly tight rental markets and very brisk increases in advertised rents. So I might leave it there and look forward to the discussion.
Thanks very much, Angus. And it's a very clear explanation. There were different trends, and something I think is very important that both you and Julie touched on is the importance of the rental market. So you explained well the point about no net change in the supply-demand balance just because investors are selling, but still we have very low vacancy rates, below 1% across Australia. So there is very tight balance between demand and supply in the rental market. These people, as Julie pointed out, can borrow 20% less than they used to be able to if they wish to buy their own home. So there's a real challenge there, and also these delays in the transmission of increased rents that Julie talked about. That is going to continue to flow through as people move on to new rental agreements particularly over the next 12 months. So there seems to be a further crunch coming. So I have two questions coming from that to just drill a bit deeper into the rental market. The first one is the effect, and this is almost a numerical point, but the effect that will have on the CPI going forward. As you know, the rental component of CPI hasn't grown that much yet, but into the future it has quite a high weight. So will we see that go up into the future? And secondly, on policy for renters. So we also saw the Productivity Commission put out their inquiry report on the National Housing and Homelessness Agreement on Friday, pointing out that low-income private renters are facing the biggest housing affordability challenge. So what should be done on policy there? So if you can start, Angus, and then pass on to Julie. Thank you.
Yeah, absolutely. I'll start with the first in terms of the boring measurement questions around the CPI, because those are, I suppose, both interesting to me and also relatively easy. The CPI measures the stock of rents. So it's every rental property, or intended to capture every rental property in Australia. Advertised rents is obviously just capturing those properties that are advertised for rent on realestate.com.au. What that means is advertised rents will swing by much more than the stock of rents, because if it's being advertised, the price is being changed, but the stock of rents is not. Most rental properties aren't being advertised in a given month, that the vast majority are not. And so most properties won't be seeing the impact of higher advertised rents flowing through the actual rents they're paying as yet. So what that means is we will start to see CPI rents, the total stock of rents, start to catch up to advertised rents, maybe not fully all the way, but we will start to see it pick up as more and more of the rental stock turns over at those higher rates. It's also worth noting, we're talking a lot about very brisk rent increases at the moment, and clearly by any measure, advertised rents are growing extremely quickly. In some areas, they fell equally as quickly during 2020 and 2021. In inner city Melbourne during 2020, rents fell by more than a quarter. Now, they're back more or less to where they were pre-pandemic and have grown extremely quickly over the past year, but in part that's catching up for that big fall in prices that we saw. It's not true everywhere, obviously, but in some parts, particularly inner city Sydney and Melbourne, we did see those big falls. Turning to the policy question, which I think is much more in depth, when we think about policies for the rental market, I think it's really important to think about who we're trying to help. So renters are a big share of the Australian household population. And as Julie said, it's roughly a third. So it is a big share of the population. For me, when I'm thinking about policies to help the rental market and to help renters, I'm really thinking about two things. So one is about low-income renters, for whom higher rents are a material cost on their disposable income and standard of living. And the other is on homelessness and the risk of homelessness. We know from US and some Australian literature, though economics is very US biased, so a lot of it is US literature, high rents and low vacancy rates significantly increase the risk of homelessness. That's a significant concern for me, and I think for policymakers at the moment. Part of the solution to that has to be more in the way of public housing. It's a significant protective factor for those at high risk, but solving that in the short term is very difficult. For helping low-income renters, I think the answer is Commonwealth rent assistance, something that the Productivity Commission flagged. The Grattan Institute's written a lot about this in the past. It's very well targeted to low-income households. It helps a lot. I think there's a strong case to look at increasing that rate at the moment to help those households.
Thanks, Angus. Julie, do you want to jump in?
Yeah, sure. I think on the like Angus, I tend to get a bit fixated on the data at times. It's a bit of an occupational hazard. The relationship between the CPI measures and housing costs does come up a lot as questions from the general public and even from within economics. And that's really because the CPI does only capture rents and associated housing costs, loan costs, but not, of course, the purchase price, because that's an asset and the CPI is about consumer prices and not asset prices. The other thing that's a bit of a quirk with Australia's inflation measures is it's taken from capital city pricing. So to the extent that it's probably not picking up the regional rent increases, which in many parts of the country have been significantly stronger than capital cities, I think it probably is understating national rent increases for a range of measurement reasons. So as Angus said, there's the stock versus the turnover problem. But I think the locations of CPI measurement might also be causing a bit of an understatement too. The policy side with the rental and housing market, there's so much going on in particular locations around the country. There's more than one reason for the rental squeeze that we're seeing, and that suggests that more than one policy response, probably from more than one level of government and government agency, is going to be required. So, we do have the movement into houses instead of apartments. We have smaller households happening. We've still got an ageing population going on in the background there. And we do have this very unusual, spread diaspora from the cities into regional locations, which is very new as from a policy perspective. And it suggests that the distribution of housing might be an issue as well. The focus of property development and on the supply side has been in the inner cities in recent decades. We've seen huge increases in apartment building, but that's not where the demand has been over the last 12 months. It's been in regional Australia, it's been in the outer suburbs, it's been back to detached houses. So, tiny homes and small area living in the inner city, it will come back, but at the moment it doesn't seem to be the preferred housing stock. It's quite difficult to adjust that kind of thing quickly. It takes time to build, and we do have this very tight constraints in the building industry. So people waiting for renovations, waiting for new homes, and in areas that have been hit by floods and storms, still waiting for housing repairs. So, the time that it's going to take to see housing supply catch up to housing demand in terms of location and suitability, as well as numbers, is definitely going to take longer than we would all like.
Thanks very much. I'm also excited by the data and very glad that we now have a monthly inflation series as well from the ABS. We're getting some questions coming in on Pigeonhole, which is fantastic. I encourage people to keep them coming. One question is quite related to what we've just been talking about, which is, has there been any impact on rental prices and availability from new services, notably Airbnb? Do you have any data on that? Julie, you can start.
We don't have, PEXA collects information on housing ownership, so probably Angus is better placed to comment on the rental listings. But I'm not sure where Airbnb fits into the picture at the moment. My understanding is there's quite a lot of movement going on between the categories. People that were listing on Airbnb took it off during COVID and put it into the permanent rental pool, just because there weren't so many holiday travellers. But I'd expect that's unwinding at the moment. Angus, is there any data on that, or are we just going on hearsay?
Yeah, it's a great question. I think it's one that is surprisingly hard to measure, as is often the Economist refrain. What I think we have seen, and it's hard to distinguish between whether it was originally a short-term rental, became a long-term rental, vice versa, is as I spoke about in my prepared remarks at the start, we've seen a lot of what used to be rental properties get sold, and some of those haven't been replaced. So while this rental stock overall has grown because, the housing stock overall, we're building more houses, has increased, it hasn't grown as much as might have otherwise been the case across the pandemic. Part of that was the fact that both short-term and long-term rental markets were pretty weak during 2020 and 2021. Obviously, not a lot of demand for Airbnbs during those periods. Borders firmly shut. Even intrastate and interstate borders were firmly shut in some cases, particularly in Melbourne. And so that was in an environment in which prices were also up very strongly, and rents in the long-term rental market had fallen, particularly in Melbourne and Sydney, but in some other inner parts of capital cities as well. So in that environment, many investors took the opportunity to sell out, higher vacancy, lower rent, no opportunities in the short-term market, but your price is up, first-time buyers are interested, many took the opportunity to sell.
Sure, it's a complicated area where we could do with better data and more analysis going forward. But thank you, that's very helpful.
There have been the other thing I've seen is quite a number of regional councils, local governments in the popular tourism areas, particularly along the New South Wales coast, but some inland areas as well, have been very publicly letter dropping residents, owners, asking them to put their holiday homes back into the rental pool. So whether that's holiday homes for their own use or for Airbnb, I don't know how successful any of them have been, but they've certainly gained quite a bit of publicity doing so.
Yeah, it's a great point, actually, Julie. And it's one of those areas I think people get very vexated by unoccupied homes. We've seen attempts to tax unoccupied homes. In the census, a little bit under 1 in 10 homes is unoccupied on census night, which sounds like a lot, but there often is a good reason for a dwelling not to be occupied. And it's not a case of the dwelling being unused. It just wasn't captured as occupied by the census. Nonetheless, we have seen that areas where home prices have grown very quickly, we did see the number of unoccupied homes fall by more. So there is some evidence that people have shifted homes into being used and out of being unoccupied in response to prices. But I'm also unconvinced that there's a huge pool of unoccupied homes that we can just suddenly activate and solve rental vacancy with. For many of these homes, there is a very good reason why they were unoccupied on census night that isn't simply that it's not being used.
Correct. And the location of those unoccupied homes matters greatly too. Right now I'm sitting in Docklands in Melbourne, which is a small apartment central, and just looking out the windows here, I can see quite a large number of unoccupied apartments, but they're very small, and many of those buildings were designed for short-term living arrangements. They're typically for international students, for expats, for very small households, 1 or 2 people. They're certainly not ever designed for large families, for example. So even if we can identify homes that are genuinely empty, there's still going to be a mismatch in terms of the type of accommodation and the location for those that are seeking rentals.
That's a good point. Thanks, Julie. There's clearly been a lot less demand for international student accommodation during the crisis, and a shift perhaps more out of urban areas as well. Yeah. So there's a related question to that from the audience about what has been the effect of the shift towards greater sea change and tree change movements, and what effect that's had on property prices and rents. Do you want to start on that, Angus?
I'd love to. I think it's one of the both most interesting and most uncertain over the next 18 months areas for me. So, the simple answer is that we've seen home prices in regional areas grow significantly quicker than in capital cities. So nationally, I said up the front, something like 35% compared to pre-pandemic nationally. Regional areas were more like 50. So very significant outperformance. If you look at the sort of really popular sea change areas, places like the Sunshine and Gold Coasts, Central Coast here in Sydney, Byron Bay, Mornington Peninsula, those have all outperformed their sort of comparable inner city areas. So Brisbane, Sydney, Melbourne, respectively. We've seen that in rents as well. Rents in these areas have grown very quickly. Rental markets are extraordinarily tight in these areas. Now, to date, we haven't seen a big shift back. So prices in regional areas are continuing to track broadly with national prices. Obviously, things are fairly volatile month to month, but we haven't seen a big unwinding that would be evidence that people are abandoning these areas and moving back to the city. For me, I think some of this shift is permanent. I think for some people, it is possible to live somewhere like the Gold Coast, telecommute to Brisbane or even to Sydney in a way that it wasn't 3 years ago. And I think we won't continue to see outperformance. I don't think these areas are going to see prices grow faster than capital cities in the way that they have over the past couple of years. But I also don't think we'll see a really rapid unwinding in these areas.
Will be an interesting one to watch over the next 18 months, as you say. Julie, did you have anything to add there?
Yeah, I think the other constraint in regional areas is just housing supply isn't able to increase to the same extent as capital cities. There's often a shortage of building workers, building trades, building materials, and many areas do, of course, have quite tight geographic constraints on the potential to increase housing stock in popular areas. So, picking up places like Byron Bay or the Mornington Peninsula, as you say, Angus, there are physical constraints in those locations. The Great Ocean Road's another popular one here in Victoria. It's got a big the Otways National Park behind it. So, some of these places, yes, they're very popular, but we're just physically not going to see a big increase in housing stock in the supply. And that does suggest that pricing will remain tight in those locations.
Thanks, Julie. And it'd be good to pick up on that point more generally about, because as economists, we're always keen to see housing supply be more responsive to price increases and removing the barriers to that. And now we have, I guess, an increasing challenge that because interest rates are rising so rapidly, that has negative effects on the construction industry as well. And so some construction companies are having trouble there. So is that going to affect the supply response going forward, and more broadly, what can be done to get more supply coming on our housing market? I'll let you start, Julie.
Yeah, sure. Within the construction industry, that sector has always had quite a large turnover in small businesses. It's one of Australia's biggest segments of employment. It's still largely run on the apprenticeship model, so that brings up the skills and training and the inflow of new talent for that sector. That turnover is still problematic. So apprenticeships fell to record low levels prior to COVID, and they are starting to creep back up. But that's probably a topic for another seminar, where we're delving into skill shortages, the relationship between higher education and the technical and further education system, the apprenticeship sector. Those things still need attention. So the construction industry has got a few challenges there, a little bit limited with falling back onto international migration to fill those skill shortages, just because of the nature of the work. It is project-based. People need to be mobile and be prepared to move around the country. As I said, regional areas, it's probably more pronounced than in the inner city, just because you're going to have a smaller pool of people to draw on. And there is always that tension between keeping the pipeline of work, relatively steady so that people can stay in work, but but not creating those huge spikes and lumps. And that's one of the reasons why the incentives the government introduced during 2020 and 2021 to renovate homes, for example, became a little bit problematic, because we were already seeing supply constraints in that industry, and then this extra surge of demand comes through for renovations that may or may not have been necessary, but were certainly being encouraged. There's also in many locations a really big backlog of homes that need repair due to flood and storm damage. So construction industry definitely facing some challenges with keeping up with demand.
Yeah, I mean, absolutely, Julie. It's construction's a pretty challenging area at the moment. Andrew, to your question, I think there's sort of two aspects. So there's a long-term supply question, which I'll give a trite answer to, because I think it's a very difficult area to give a really detailed and proper answer to, which is we need to do a lot more to encourage supply in Australia. In my view, a big part of why housing is as expensive as it is that we simply didn't build enough, particularly through the mid-thousands and early teens. We've probably done a bit better in the past 5-6 years, but through that period, we probably just didn't build enough homes for the number of people and number of households that we have in Australia. In terms of the short term and the constraints on building activity and the difficulty that builders are facing, that's a bit of an easier one to answer, because it's quite a lot more tangible. Big part of the problem we're facing at the moment is just construction costs have absolutely skyrocketed. The cost of building detached homes in the producer price index, which is how the ABS tracks inputs and outputs to the construction industry, is up, from memory, something like 20% in the past year. Don't quote me on that, but it's in that order, which is brisk by any measure. And it's across a broad range of inputs. At the same time, as Julie's saying, you're seeing a lot of labour shortages, particularly in the other factor that's had an impact on labour shortages is the fact that there's been a lot of lost days due to sickness. And in Sydney and Brisbane, a lot of lost days due to weather, because it's just not stopped raining for like 9 months. It's getting pretty tedious, to be honest. That's all compounding with the fact that we actually have a record number of detached homes under construction at the moment. And when I say at the moment, I mean when we last had data, which is a little bit delayed because of data delays. During the pandemic, we saw a huge surge in approvals and commencements of detached homes, in part due to home builder, in part due to low interest rates. We know that building activity is one of, if not the most interest rate sensitive parts of economic activity. So the whole point of low interest rates was to encourage construction. And as we raise interest rates, that will damp down on that construction activity. But at the moment, we still have an enormous pipeline of detached homes under construction. And because of all those constraints, it's probably going to take longer than typical to work through that backlog.
Thanks a lot, and point taken that supply is very important, even if we can't go into a full conversation of all the solutions here. And thank you, Julie, also for pointing out the importance of the apprenticeship model. And there are some challenges there around not as many people finishing apprenticeships as we would like. I'll go to some of the other questions, and the most voted for question we've got comes down to interest rate sensitivity, but more generally than just the construction sector. So the question is, while the big banks have said they're unconcerned about being impacted by mass defaults, what are the actual chances of mass defaults, regardless of their impact on the bank's bottom line? So Julie, you mentioned some data around the cumulative increase of $11,000 a year in repayments with the interest rate rises. What are your thoughts on this?
Yeah, that's an interesting one for Australia. During the GFC, I was at one of the major banks as an economist, and we were looking at exactly this question. Australia's banking sector is more tightly regulated than almost any other country, and certainly more than in the US. The buffers that are built in with borrowing capacity are quite conservative. So the rates rises that we're seeing, yes, they are steep and very rapid, but particularly for the new borrowers, if they've done their approvals correctly and all has been ticked off as it should be, by their broker and their lender, then they should have a bit of a buffer in there to cover those increased costs. Australia doesn't have anything sort of resembling the US model of non-bank lending. Almost all of the lending to households in Australia is through the major banks and the smaller bank lenders, but all very heavily regulated. So there is a fair bit more safety and caution and conservatism, really, in terms of financial capacity to carry that debt. The RBA's done a little bit of analysis, and Treasury also, on the distribution of debt. And of course, the higher income households do tend to have larger debts, but they also have better debt servicing capacity. So at the lower income levels where we are more concerned about mortgage stress, the suburbs that often stand out for mortgage stress and for concerns about defaults are in those newer areas and the low income areas. But even there, the default rates do tend to be very low and not necessarily related to interest rates. Statistically, the biggest indicator of default is job loss. So a rising unemployment rate is actually a much bigger concern than rising interest rates when we look at the potential for people to actually lose their homes or to move from home ownership back into rental. The other factor in Australia which causes people to really hang on as long as they can or to sell and find another option is just to do with the debt laws and loan laws in Australia. If you default on your loan, you're not just liable for the cost of the sale cost of the house, it's actually the full mortgage. So if you get into a situation where your loan is larger than the value of your house, you still need to pay that difference. So we don't have that situation where there's an incentive for people to walk away from their homes and from their loans, as happens in some places globally, where the only liability is the value of the home rather than the loan.
Yeah, you can't just hand back the keys. That's a good point. As in the United States, for example, and I think your
default sales are relatively rare in Australia. What is a more common scenario is people can see it coming and they may sell for that reason, but it won't actually show up as a default loan.
And income losses when you lose a job are generally quite
Correct.
high in Australia, and that does put pressure, as you say, and that distribution is very important about who is holding this high debt, because relatively high income earners are probably able to reduce their discretionary spending more as well. So I think it's very important to look beyond just the headline figures. Thank you for the detailed response. I have a question that is coming back to our point about the supply issues, and it says, on the topic of supply and geographic constraints, does Australia overinvest in suburban sprawl in its capital cities in order to increase supply? Views on that, Angus?
Look, that's almost a negatively framed question, so I think I'll have to be fairly careful in how I answer it. Maybe to put some facts in front before I get into a sort of more normative answer to the question, the vast majority of housing in Australia is detached homes, but of what we build, it is increasingly apartments. It's still, the majority of what we build is still detached homes, but we do build, proportionally speaking, more apartments today than the stock overall. So we are starting to increase density in the inner city. Broadly though, yes, we are quite large cities in Australia, not necessarily compared to some other global cities, particularly in the US, that sprawl even larger, but I'm in favor of more infill density. I think there's a lot of benefits from higher density in our inner cities. Melbourne does a relatively good job of this. There's a lot of high density construction in Melbourne's inner city. Sydney has a bit funny development pattern where a lot of our infill density happens a little bit more towards the middle ring. For those that are from Sydney, places like Rhodes, Chatswood, Rosebery, we build a lot of apartments there, which are still reasonably in a city, but a bit further out. And I think we'd benefit from pulling some of that development even closer into the city, where public transport can support it, where it's a bit more walkable and you're not relying as much on road infrastructure.
Julie, any comments on that?
Yeah, look, I think Australia's housing supply and the build patterns have responded to demand at the time, and those demand patterns change over the decades. I think what's been unusual in the last couple of years has been quite rapid shifts in housing demand. As I said earlier, I don't know that supply has kept up as well. So to the extent that, you know, our cities are generally detached housing and spread out, that reflects the type of housing that was demanded at the time that those areas were built. So, you know, we can't change them retrospectively.
No, I think that's an important point, and we should be trying to provide the type of housing that people want. It's just perhaps there's opportunities in some of those inner city areas in Sydney, for example, that Angus talked about, to remove barriers to providing the types of housing that people want in areas that enable them to have closer proximity to work and recreation. So.
Correct.
Yeah.
And going forward, you know, the big storms that we've seen are a good illustration of rising awareness of climate change impacts and how that will affect the type and location of housing that people want. So traditionally, living near the coast and living next to a river or next to a lake has been highly desirable. However, I think that's probably changing with the weather patterns that we're seeing. Perhaps if we move back into a decade-long drought, then living right on the Brisbane River will be seen as eminently desirable again.
Yeah, here in Brisbane, I was about to cite the Brisbane River and housing in West End as a good example of that.
Yeah, I think it's a bad case of just, you know, not retaining that long-term memory of weather patterns and conditions in particular locations.
Yeah, and there's been interesting studies done on that, on how long it takes the housing market to sort of recover, and it suggests people do have fairly short memories. There's a question here about, I guess, the sort of speculation in the housing market. The question is it possible to wind down the housing market as an investment market without destabilising the economy? So I guess it's thinking of this kind of competition between different buyers. What's your view on that, Julie?
Look, I've got to ask, why would you want to? I know there's often in the public discourse this idea that it's sort of investors versus first home buyers, but you need the investors in the market to provide the rental housing that, you know, a third of the population needs and wants. So we need to be a little bit careful about picking out particular categories of home buyers or home ownership. I don't think there's a magic number that we'd be aiming at for any of these categories.
Yeah, I think it's a really interesting area, and obviously a very controversial one given the history of some of these policies. I think for me, maybe a more constructive answer to, or constructive question even, around investors is, how do we structure taxation arrangements to ensure that we're delivering the housing stock that we need in the country? And for me, a big barrier at the moment and a bit of a artificial wedge is in the way that we levy land tax on investors but not owner-occupiers, and on larger investors but not on smaller ones. That basically rules out institutional ownership and build to rent in Australia in a way that isn't the case elsewhere in the world. And when you look at the data, Australia's housing stock is overwhelmingly, it's not quite 100%, but you'd have to really squint to not see it, 100% owned by households, which is just not the case elsewhere in the world. Institutional ownership and government ownership is a lot more common in other countries. I think part of that is the fact that, you know, investing in rentals is very attractive from a tax perspective, both from land tax and from personal income tax in Australia. And some of that, particularly on the land tax side, I think could do with a revisit to encourage build to rent, because with rental markets as tight as they are, I think build to rent is going to be an important way that we can start to bring some supply into the market.
Yeah, that's
there was some good pointers in the Productivity Commission report that was out last week. They reiterated the importance of looking further at taxation incentives and the impact that they're having. So moving, for example, from the transaction-based stamp duty towards a more widespread and consistent land tax base is one of their recommendations, and then also bringing property assets more closely aligned with other assets in terms of the way they are taxed.
And your points are well taken, that we don't want to cause more hardship for the 32% of Australians who are renting. And it's more about getting the incentives right. And your point, Angus, is a good one about having a very progressive land tax is a disincentive to having bigger businesses and having more of a portfolio of properties.
Well, while we're on that policy issue of taxation, something to consider for Australia as well is that we've got 3 levels of government involved in the housing market, all of them doing their own thing and acting in ways that have pulled the market in different directions. So, we've got local government at the planning level, we've got state governments, we've got federal government. They're all involved in the taxation arrangements, in the financial incentives that are at play across the housing market, and the coordination isn't quite there. There's quite different incentives in each state, and in some cases even across local government areas. So it does get quite complex, and some national uniformity would be great.
Thanks very much. We are down to 4 minutes left. There's one question that I'd like to get to as a very final one, but hopefully you can give a short response. But there was a question about a national rent freeze, and we've all talked about the importance of looking after renters. Do you think a national rent freeze, the question is, would be a good way to protect renters?
Look, I sympathise with wanting to help renters, but to the point that I made a bit earlier, I think when we think about how we want to help the rental market broadly, which is a third of Australians, it's really important to think about the problems that we're trying to solve. And for me, the problems that we're trying to solve and the problems that a rent freeze would be trying to solve is low-income households spend a lot on housing, and big increases in housing materially worsens their living standard. So a rent freeze would help with that, but it would be equally helping with high-income renters. So it's not a very well-targeted policy, and I'd rather see Commonwealth rent assistance increase to help those low-income households, because that is well-targeted, and rent freezes have other impacts in terms of longer term, the incentives to invest in rental supply. The other flip side is in terms of homelessness. We know that increasing rents does put more people at risk of homelessness. Again, I don't think a rent freeze is a great approach here. The evidence we have from the US is that it has, broadly speaking, no impact. It helps because it keeps rents low, but it also, in the long term, makes vacancy rates lower, which increases the risk of homelessness. And these two things broadly offset. So I think I understand why people are interested in this. I think it's an attractive way to solve some of those problems, but I think there are better levers, and I'd rather use those levers than a rent freeze.
Very clear. Thanks, Angus. We need to think about the supply side. Did you have anything final to add there, Julie?
Oh, just on the rent freeze idea, I think the concerns that we all have for housing for low-income households is, one is affordability, but others are about security, availability, appropriateness. And I'd be concerned that a rent freeze, yes, it might assist in the short term on affordability, but the effects on those other really important variables, particularly availability and appropriateness of housing, would be of concern. We don't have a huge amount of mobility, and that needs to be encouraged.
Great, thanks. That's an important topic to finish on. Mobility might be a topic for another discussion. So I'll finish the conversation there. I'd really like to thank you, Julie and Angus, today for sharing your insights and expertise. I learned a lot. It was a very interesting conversation. For those in the audience, please take a minute before you log off Pigeonhole to provide your feedback and rate today's discussion. And I'd like to thank the audience for your time and participation in the discussion. I think we had some really good questions. I'm sorry we couldn't quite get to all of them. And I'd remind you that the discussion's been recorded and will soon be available via your live stream link and on the CEDA website next week for you to share with colleagues and network. And you can stay in touch with upcoming discussions via ceda.com.au, where you can also register for CEDA's upcoming events. And I'll just mention one, which is on Monday, 5 December. We'll have a live stream labour market update entitled Mind the Skills Gap. So thanks very much and enjoy the rest of your day.